We've just witnessed one of the most dramatic moments in precious metals history. Gold surged steadily for months, silver stayed quiet, then suddenly, everything changed. Gold climbed in a slow, controlled way. Silver exploded in just days. And now many people are asking, was this a bubble? Is the rally over? Or is this only the beginning? Let's break it all down. Gold didn't spike overnight. It quietly broke out in early 2024 and began a steady climb, rising methodically toward the 4,000 level. No hype, no frenzy, just consistent accumulation. Then something changed. Once gold crossed 4,000, momentum accelerated rapidly, pushing prices above 5,500 in a surprisingly short time. Silver, meanwhile, barely moved during gold's early advance. While gold doubled, silver stayed almost flat. That created a massive imbalance. Eventually, silver caught up, and when it did, it moved violently. Silver shot from the low levels straight toward triple digits in what felt like days. This wasn't normal price action. This was a breakout decades in the making. The key level was 50. Once silver broke above that price, something powerful happened. That level had acted as resistance for generations. When it finally gave way, massive amounts of capital rushed in. Traders, funds, investors, everyone wanted exposure. But silver didn't climb gently. It launched vertically, racing from around 80 to above 120 almost instantly. That kind of move attracts speculation, and speculation brings volatility. After silver surged, exchanges stepped in with multiple margin hikes that forced leveraged traders to liquidate. Weak hands were shaken out. Positions were closed. Suddenly headlines appeared. Silver bubble. Silver crash. But real bubbles don't form in days. They form over years. What we saw was a violent correction after an historic breakout. Silver fell from around 120 into the 70s. That's painful, but not unusual after such a massive surge. Gold, meanwhile, only pulled back about 10% from its highs. Silver dropped harder because silver always moves more aggressively. That's simply how silver behaves. Despite the volatility, the bigger picture remains intact. Silver is still holding far above its old resistance. That's critical. Corrections don't cancel breakouts. They confirm them. Even if silver dips into the upper 60s or low 70s, that doesn't invalidate the move. It simply resets momentum. More importantly, silver is not going back below 50. That level is now structural support. This is what early stages of a bull market look like. Fast rallies, sharp pullbacks, then consolidation. After that, higher highs. Here's something most people miss. Paper prices can fall, but physical silver is becoming harder to find. Premiums on coins and bars are rising. Low denomination silver is especially scarce. So even if futures prices drop, physical buyers often don't get cheaper metal. Why? Because real silver is limited by actual supply. You can't put a futures contract into a battery. Manufacturers need real metal. Industries need real silver. And demand keeps growing, especially for energy storage and technology. This creates a growing disconnect between paper markets and physical reality. Eventually, that gap closes. Historically, it closes by prices moving higher. Now zoom out. The global economy is drowning in debt. Trillions are being added every year. Growth looks strong on paper, but much of it is inflation. Massive spending is being driven by artificial intelligence infrastructure. Hundreds of billions are flowing into data centers, chips, and energy systems. But here's the uncomfortable question. Where is that money coming from? And what isn't being funded because of it? No economy has unlimited capital. This level of spending always creates distortions. At the same time, confidence in fiat currencies continues to erode. Central banks are quietly shifting reserves. Foreign institutions are reducing dollar exposure. Gold is becoming the neutral asset again, not because of fear, but because of math. When debt rises faster than productivity, currencies lose purchasing power. Gold doesn't. Silver doesn't. Even after gold's massive rise, mining stocks remain historically cheap. Wall Street largely dismissed the rally. Many analysts expected gold to peak years ago. They were wrong, yet valuations haven't fully adjusted. Meanwhile, operating costs for miners are falling. Energy prices are relatively low. Local currencies in mining regions remain weak. Silver, a byproduct of gold mining, is now worth much more, effectively lowering production costs even further. That means margins are expanding dramatically. As when gold prices rise, mining profits don't just increase, they multiply. This leverage hasn't been fully priced in yet. Silver's drop from its peak isn't a collapse. It's a reset. Gold remains in a powerful bull market. Silver has completed a historic breakout. Volatility will continue. But this is how early bull markets behave. Sharp moves, emotional swings, then sustained advances, physical supply is tightening. Global debt is accelerating. Confidence in paper currencies is fading. All roads point toward higher precious metals prices over time. This isn't the end of the move. It's just the beginning of a much bigger cycle. If you found this breakdown helpful, support the channel with a like and subscribe for more deep dives into gold, silver, and global markets. Thanks for watching, and stay prepared.